Just because they aren't at a bubble extreme doesn't imply they hold safety or that it's an excellent period to get long. Bubbles may need a long time to unwind and usually move to the opposite end. Hello and welcome back to our channel. The topic of today's video is the entire asset bubble is going to collapse and trap the Fed, and Ray Dalio. Watch this video till the end and don't forget to subscribe to our channel. Let's begin. American hedge fund manager and billionaire investor Raymond Thomas Dalio popularized many current use techniques, including overlay of currency, risk parity, portable alpha, and management of worldwide inflation-indexed bonds. Innovations brought by him are considered among the best in the industry. Commodity futures had modest borrowing restrictions when Dalio was in school, and he realized he could benefit handsomely from them rather than from straightforward stocks. He then worked as a clerk at the New York Stock Exchange. After his first year at Harvard, the following summer, Dalio and his friends founded the business that eventually became Bridgewater Associates. He characterizes a bubble market as having a high concentration of the following factors. 1. High rates relative to value's traditional measures. 2. Situations that are not sustainable. 3. Plenty of fresh and naive buyers who were interested because of the growth of the market, so it's considered a hot market. 4. Large bullish sentiment. 5. A lot percentage of purchases getting financed from debt. And 6. Various forward and speculative purchases done for betting on rate gains. Just because they aren't at a bubble extreme doesn't imply that they hold safety or that it's a good period to get long. Based on our metrics, U.S. stocks as a whole continue to appear overvalued. History demonstrates that once a bubble starts to bust, it tends to overcorrect to the downside rather than stabilize at more traditional values. Ray Dalio stated that if the U.S. Federal Reserve rapidly raises interest rates to combat inflation, equity markets will experience a dramatic decline. Following a hotter-than-expected inflation report, which raised concerns that the Fed might raise interest rates more aggressively and increase the likelihood of a recession, he forecasted about the markets and the economy. In a LinkedIn article, Dalio stated, "It appears that interest rates will need to rise significantly. This will slow down the expansion of private sector credit, which will slow down private sector spending, and ultimately the economy will also come down." Concerns regarding U.S. market prices have increased due to Dalio's bearish outlook. U.S. inflation is steadfastly high. The Consumer Price Index in the U.S. rose from 0.1% from July to August after remaining unchanged in July, according to data from the Labor Department. From a year earlier, prices rose 8.3%, a slight deceleration, mainly because of recent drops in gasoline prices. According to Dalio, the U.S. yield curve will remain flat until the economy experiences an unacceptable adverse impact. Because cash and wealth levels are currently very high, a significant economic contraction will be needed, but it'll take some time to occur, Dalio wrote. As the Fed changes course to enable markets to clear instead of artificially sustaining asset prices, the everything bubble is quickly deflating. Declining prices and unsustainable tax cuts previously boosted markets, but it looks like a new era is about to begin. The everything bubble is quickly deflating as investors realize that the Fed cannot continue to hold rates at zero and fix mortgages and trash bonds to lower market prices. The Fed can't agree to the compromises required to stop inflation and allow unbeneficial businesses to fail. Paul Volcker's interest rate increases in the early 1980s and the 1986 tax reform, which reduced income tax rates from more than 45% to 28% at the expense of wealthy real estate investors, are examples of when it has been done. Famous macro investors are often unfavorable. Recently, Bridgewater and Ray Dalio predicted an additional 20 to 25% decline. According to Stanley Druckenmiller, there is a good chance that markets will remain stagnant for a decade. Of course, more and more catastrophic warnings have been made by individuals like Michael Burry and Nouriel Roubini. Even while I'm not as pessimistic as the majority of them, it's difficult to deny how many unsustainable elements have contributed to the market's performance over the past 10 years. With the largely unsuccessful findings behind us, markets will eventually reallocate squandered resources toward innovation and development because the free market price for large-cap equities is less than it was in a world of zero interest rates and QE. Investing, trading, loss, and profits are all like a roller coaster. Stay careful, always. We hope you found this video informative. We'd love to read your response in the comments below. Thank you.